So hello to you on another beautiful August day here in Edinburgh. I've just climbed to the top of Calton Hill, so if I'm a little bit out of breath, you know why. There's a beautiful view you can see in the distance. And today we ask, is gold cheap relative to equities? And I'm going to check in on some charts that I haven't looked at in a very long time, but they're very useful charts to look at. And that is the Dow-gold ratio, the long-term ratio between the price of gold and the value of the 30 most prominent companies in the US, or 30 of the most prominent companies in the US, aka the Dow Jones Industrial Average. And what's the purpose of this exercise? Effectively, excuse me, I'm just speeding this up a little bit. You are measuring stocks in money that hasn't been debased. Now, there are many who argue that the gold price is suppressed, but we're going to put such thoughts to one side and accept that even if the gold price is suppressed, gold's value, its purchasing power, has preserved way better than the US dollars, or indeed any national currency. So in this instance, gold is a better unit of account. That's one of the purposes of money. And the act of valuing stock prices in gold can tell you quite quickly which asset is cheap and which is expensive. So we're going to start here, courtesy of Nick Laird over at Gold Charts or Us, by taking a look at the Dow to gold ratio since, get this, 1800. Now, there's a lot to take in here, and the period from 1800 to 1913 is of considerable historical interest, but it's fairly irrelevant to us as investors. Gold was money in the 19th century, and the US stock market was very, very young. Nevertheless, you can see how the value of America's companies grew incrementally over the course of that century, but in a relatively measured way. There wasn't the volatility that came with the post-1913 era of central banking. And when that black line is rising, it means that stocks are rising in price relative to gold. So turning next to the post-1913 era, and Nick has drawn a vertical red line at 1913 because that is when the US Federal Reserve Bank was formed. The following year, the UK, France and Germany all abandoned their gold standards to print the money to pay for World War I. We're forever going on about that. And the period saw a major sea change in the evolution of money and banking. And you can see that there were three major highs in 1929, in 1971, and again in 2000. These were all years that saw major financial turning points. 1929 was the top of the stock market before the Great Crash. 1971 was the year President Nixon took the US off the gold standard. And 2000 was the year .com peaked, while gold, meanwhile, came to the end of a 20-year bear market. Also notable are the years 1932 to 1933, the low in stocks in the Great Depression, and the time that President Roosevelt confiscated Americans' gold and then devalued the dollar. And 1982, that was the year that the great gold bull market of the 1970s came to an end. Gold spiked with the Iranian hostage crisis to $850 an ounce for less than a day, and with Fed Chief Paul Volcker's raising the Fed's fund rate to 20%, the era of inflation, by their definition, came to an end, and that was the stage was set for the next bull market in stocks. So here is the last 120 years in close-up, starting at 1900, and with the Dow today at 33,800 and gold at $17.90 an ounce, it takes 19 ounces to buy the Dow. So gold is right in the middle of the range. It's neither expensive nor cheap, and the same could be said of stocks. Now, there are many who argue that the Dow-gold ratio is going back to 1, as it did in 1980. And that return could take many forms. There could be an extraordinary bull market in gold, inflation in the US dollar, and stocks could simply remain flash. Oh, I've walked into the sun and it's remain flat, and it's very bright. And in such a scenario, gold would have to go to $33,000 an ounce. I don't think that's going to happen unless the US suddenly decides it's going to settle its debts with its gold and revalues the price upwards. Very unlikely. I suppose it's possible that some deflationary panic, a war or a global pandemic, something like that could send stocks tumbling by 50% while gold itself goes up 10 times. Again, possible, but unlikely. But those are the kind of scenarios you would need for that ratio to go back to 1. I just don't think it's realistic. I own gold, so I wouldn't necessarily be opposed to it happening. It might have been normal in the 19th century, but not today. On the other hand, a runaway bull market in stocks could see the Dow double over the next 3 years, while the world becomes even less interested in the analogue asset that is gold, sending the price back to 1,300. In that kind of scenario, you would have a Dow to gold ratio at 50. It would be above and beyond that green confidence band on the chart, at extremities. But I have to say, I would have thought a Dow to gold ratio at 50 is more likely than one at 1. But based on the chart, gold is probably a sell below 10 on the ratio, where it went to in 2011. Alternatively, here is the S&P 500 to gold ratio, and with the S&P currently at 4,120 and gold at 17.90 an ounce, that ratio currently stands at 2.3. 2.3 ounces of gold to buy the S&P. And this is a ratio, in my opinion, that could easily go to 1. If the S&P comes off a little bit, say 25% to 3,000, while gold has a big run to 3,000, which is not such an impossible number, the S&P gold ratio will hit 1. It's unlikely, but not impossible. Similarly, the S&P could go to 7,000, could double, as gold falls to 1,500. And then you've got an S&P gold ratio at 5. Not such an impossibility. Broadly speaking, stocks have been rising relative to gold since 2011, when gold last peaked. And in the last 3 years, they've wobbled a bit. So where's that S&P to gold ratio headed? To 1 or to 5? Or do we stay where we are, around 2? It's a big call, but it's an important one to get right as you allocate assets for the next cycle. Thanks very much for watching. Please subscribe to the channel. Please subscribe to my Substack. There are links on the screen and in the comments below. If you're interested in buying gold, take a look at the Pure Gold Company. That's my preferred bullion dealer. I've got a affiliation deal with them, and I'll be back with another video then. Sorry, I got cut off there. I was just saying that I have an affiliation deal with the Pure Gold Company, and they're my recommended bullion dealer, and I will be back with another video very soon. And I'm now going to hold my camera up, and hopefully over there somewhere you can see, oh no you can't, Arthur's Seat. No, you can't. Never mind. See you soon. Bye.